All right. Hey, welcome everybody to Apiary YouTube Live. Excuse me. I'm Nate Allred. I'm here with my good friend Steve Perry today about money management and kind of some of the tricks of the trade and what to do, how it fits in your overall scheme of trading. You know how the old adage goes, the number one reason why traders fail? Lack of money management, right? So to kind of start out our discussion today, Steve, if you don't mind, I think what we do, what the equation in most people's mind is that it goes something like this. They have a system or a strategy plus the trader equals profit and loss. And they say, okay, so if my strategy's good, if my psychology's good, then I'm going to make money, right? That's kind of the overall thought process or equation that people use when determining if something is good or not. But I want to focus on this aspect of the system and really kind of talk about it because the system really has two different parts to it. First, you have the pattern that you're trading. So this would be like, are you trading breakouts? Are you trading a pullback? Are you trading head and shoulders pattern or whatever? But then you also have to take into account the money management aspect. And so at any given point in a trade, we all know that, let's say that we're trading on a daily chart, right? Mm-hmm. If I'm trading on a daily chart, at any given point in that trade, especially in the beginning, I can be up 20 pips, I can be down 20 pips, and there's not, I don't have a crystal ball, otherwise I'd go all in, right? But I don't know at any given point whether I'm going to be up or down, but being down 20 pips is not out of the ordinary, right? And why is that? It is because there's a component of volatility in the money management that we have, right? And so one of the things that I personally like to do with my trading is I like to take multiple positions, because what I can then do is I can use that volatility that's naturally in the market. And you see Sean do this a lot of times. I know you're really good. I'll let you talk here in just a second kind of about the tricks of the trade that you use. But I like to take multiple positions because if I'm up 3 pips, what I can do is I can scalp off some of that money, right? Mm-hmm. So if I have we'll go back to my daily example. If I have a 50 pip stop loss, that's a normal stop loss for a daily trade, mm-hmm. right? So if I'm up 20 pips, guess what I do? If I take it off the table, my risk has gone down from 50 pips minus 20. I'm now down, my overall risk is 30 pips. And if I can do that just within volatility, I can actually work in and out into a zero risk trade, mm-hmm. right? Now, it's not zero risk when we start our position, sure. but we can get to that point. And I know that different money managers have different stands on position sizing. I mean, you have like the turtle traders, mm-hmm. right? I mean, the turtle traders are famous for adding to their positions, right? You have like a martingale system. Martingale, what they do is they add to a losing position. You have like a Warren Buffett. He just says, well, never lose, yeah. right? But what are some of the tricks? How do you do it with your trading? I know you've been a money manager for a while. How do you manage the multiple positions, and what are some of the tricks of the trade that you use?
Okay, good question. Thanks, Nate. So like you said, when the volatility is a huge factor, especially when you're trading on a daily chart or a 4-hour chart, a 5 pip stop loss just isn't gonna work. And so, especially in our signals program, we always look at first of all, what's the context of the trade? Are we on a daily chart, 4-hour chart, or are we scalping on a 1-minute chart? And so we always look at that first, and then we'll know, okay, is it appropriate to go for 50 pips for a long-term trade or more? And we always want to know, okay, what's the lot size we can afford? And we've noticed that when we take these long-term trades in signals, it seems like we're using smaller lot sizes, and that's for a reason. Because if we were to use, let's say on a scalp trade, we use a full contract, let's say, and we're going for 10 pips on that trade. If we all of a sudden take that full contract and trade on a daily chart, it could blow up the account if the account's not large enough. Right, so we look at the account size. That's really important. We look at the time frame that we're trading on, and then you add another aspect, like you were mentioning. If you add to that position, if you have multiple trades, then you're also adding more potential loss, potential profits, and you have the opportunity: do you add to that position or not? So sometimes what we'll do is we'll add to the position if we find a system or a chart pattern that suggests that the market should go up, we'll buy. And if the market does go up and we have another pattern that suggests it should continue higher, we should have a continuation, we might add to that position. In other cases, sometimes, in fact, we had a trade just the other day that started going against us, but the pattern was still holding, so we decided to add to that position, and the trade actually ended up making profits.
That's a good example. And I think you brought out the point really well, is that as long as it's okay to take a stance like a martingale approach sometimes in the market, not every time, right? It's okay to take the turtle traders approach and add to a winning position sometimes in the market, right? I think the biggest lesson and things that we could take from this is that we always need to be aware, at least for me, of what is this money management here? What's the overall risk to my total account, right? So if I'm taking a martingale approach and I'm adding to a losing position, I think a lot of people see Sean will add to a losing position sometimes, right? But he's doing it with such a small amount of risk. The overall risk to his portfolio is negligible. But people, it's kind of like my kids. Well, my 10-year-old did it, and I'm 5, so I should be able to do the exact. I should be able to play with matches too, right? But what they don't realize is if you're taking a 2% risk, Sean's taking a fraction of a percent of a risk and adding to that position, and so overall, what we have to do is we have to keep in mind the overall risk, the actual risk that we're taking on by adding to a position, whether that's adding to it when it's going in our favor or adding to it as it's coming against us. Maybe what are some techniques or tricks of the trade that you use or have used in the past for position sizing?
Okay, good question. So actually I want to illustrate this with an experience I had a while ago. About a year ago, I got an increase in funding here at the Apiary Fund, and it was one of the largest accounts here at the fund, and I started trading this account, and it was late one Friday, and I found a pattern that looked good to me. I traded the pound and put a half contract on that trade, and it started going against me immediately. I mean, just right off the bat, and I unfortunately didn't have an exit for the strategy. I thought it'd be in and out, and I didn't really have to worry about the exit on it. So I decided, okay, well, it went up. Oh, this is good. I'll add another position. So I added another half contract, and by this point, I'm actually close to a quarter leverage of the account. I'm using a large portion of the leverage. Then I add another half contract, another half contract, another half contract, and eventually I actually max out the account. And it's a mistake that I regret, but I've learned from that mistake. And obviously, Apiary eventually the system kicked me out of the trade, and I had to stop trading for that weekend and kind of review my strategy. Wiped out all the profits I had made on the week, and I had to come back and try to dig myself out of it. But on the flip side, I've also made lots of money. One day I made 12% of my account. It was the best day I've ever had. And it actually happened on a day where I was adding to a winning position. And the anti-martingale approach. It was same thing with pound dollar. I was able to catch the market on a huge rally, adding to that position frequently overnight. It was an overnight trade as well. So another technique that we use in signals is a lot of the times when we have the opportunity to book profits, we will close our position or book partial positions through a hedge. Hedging is a great technique that we use as well. So.
Yeah. So wrapping this up, I think maybe one of the biggest lessons that I've learned through watching hundreds and thousands of traders come through the Apiary Fund is that if I can pinpoint one killer of success, okay? It's money management or lack thereof, right? I see too many accounts blow up because they take, like you were doing, they take too big a position size, right? And then we do have to shut them down, which is actually a positive thing, because imagine if you keep adding and keep adding and keep adding. I mean, actually, martingale is a great approach martingale always works if, and this is a big if you have unlimited money, right? So I'm not the Federal Reserve, you're not the Federal Reserve, so we always have to understand that there has to be an eject button, unless you're Jerome Powell, right? And then they do whatever they do because they can just print money. But if we understand what our position is, and we understand what the overall risk is on the account, and we're okay with that risk, whether it's 1%, whether it's 5%, whatever, as long as we're within those parameters, it works out. So one of the things I think you illustrated really well that I love to do is to add to a winning position. And the turtle traders were fantastic. This is why they made millions on millions on millions of dollars in that short time that they were doing it, is because they would go in with a small contract. It was a test position, and if they got it correct, if it still continued in their favor, they added a ton to that position, right? And that's what I like to do when we're in a trending market. And this is the key: when you're in a trending market, that's the time to be greedy. That's the time to keep going in. Obviously, you don't go in forever, but you add to a position. The martingale approach, it works in a consolidating market, right? But as soon as you go into a trend, you got to hit that eject button and make sure that you're always limiting your risk. Otherwise, eventually martingale does blow up. Wrapping up, what are some of the lessons or takeaways that you would want our traders to take away from our discussion here?
Good. Absolutely. I think something we always mention at the beginning of every webinar, we always have our disclaimer, right? And we always kind of just run through it. But something we always say is always define your risk, right? What does that mean? Ask yourself, what does that mean to define my risk? What account do I have and what is appropriate for this account? We've mentioned that several times throughout today, and I think we just need to always remember that. And some of the best traders I know are the ones who can look at me in the eyes and say, I know exactly when I'm getting in, and I know when I'm getting out. I know when I'm getting out for profit, and I know when I'm getting out for a loss. There's two types of exits: the exit for loss and the exit for profit. And you have to know clearly when are those points, and those are the best traders we have. Those are the ones that make money, right?
Yeah, absolutely. It's funny that you brought up the disclaimer, because if you come on the live ones, I actually wrap the disclaimer, so it's a wrap. I'll do it on the next webinar for you, but always remember money management is the biggest, most important aspect of any trading system. So if you're going in, like I like to do, with two positions in the beginning, there's a time component where there's going to be volatility to come into play, and then there's also a dollar component where I'm down or up pips, and so if I can go in and kind of offset those positions, I can work into a position so that when the pattern fulfills itself, we're in a winning position. We're in a lot better position. I found that works. So always keep in mind what your risk is and the actual risk. And I always have to say actual risk, because if you're in two positions and you have 20 pips of risk, that's not your real risk. Your real risk is two positions times 20 pips, right? So as soon as you are out of one of those positions and you've taken 5 pips, at that point you're now at 15 pips of actual risk, right? And so keep that in mind as you're trading. And hopefully this has been helpful for you. Steve, we really appreciate you coming. Hopefully you'll come on again and share some of your wisdom with us.
Hey, Nate. You briefly mentioned that we're not going to be doing this next week because?
Oh yes, thanks Dave. We're not going to be doing the Trader Live next week because we're going to be at the Trader Summit. So we try to do the YouTube Live every single week, but next week, unfortunately, well, fortunately for us, we're going to be holding the San Francisco Summit. I believe we only have about 1 or 2 more seats available. So if you're interested, contact me. Just shoot me an email, nate@apiaryfund.com. But it's a great time. You've come to the summits, and they're by far the best thing that we do. We get to interact with the traders. We get to spend a lot of one-on-one time trading with them at the summit. I can't say enough about the Apiary Fund Summit. So anyway, hopefully we'll see you the week after, and maybe we'll see you guys at the summit. So thank you very much. Happy trading.